Hello, I'm Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. In this episode, we're focusing on how the prospects of interest rate cuts may impact the bond market. Joining me to offer his expert insights is Brett Pybus, Global Co-Head of iShares Fixed Income ETFs at BlackRock. So Brett, to start off, could you give an overview over how bond markets have reacted and performed since interest rates started rising at the end of 2021?
Well, I think we're in a new regime which is really characterised by much greater macroeconomic and market volatility. 2022 was a really challenged year from a return perspective for bond markets. They sort of bottomed in September of that year. And then, we've seen better performance through 2023 and year to date. What we're seeing is, obviously, as rates have increased, yield levels are much more attractive to investors who had perhaps been on the sidelines or in other risk assets. That, from our lens, from an ETF perspective, has been characterised by significant inflows into fixed income ETFs, or the Bond ETFs. So we saw globally about 333 billion go in 2023, and it's been a similarly strong period year to date in 2024. Overall, the other aspect that I would highlight in the environment that we're in today is the shape of the yield curve. So we're in a very unusual period where, in the terminology, yield curves are inverted. So what that means is interest rates for shorter dated maturities are higher than for longer dated maturities. So that has led to a lot of interest in shorter maturity fixed income relative to taking more interest rate risk or more duration risk in the lingo.
And usually with the yield curve, yields are higher for longer duration bonds, and that is in order to compensate investors for lending their money for longer. That's correct, isn't it?
Correct, yeah. So you'd expect to be paid an additional term premium or an additional interest rate, if you like, for that incremental risk.
So why is it at the moment that shorter life bonds are offering higher yield than bonds that are, going to mature in 20 or 30 years' time?
It kind of points to to significant demand for longer dated assets, which is really driven by longer dated growth expectations. So that's sort of in conflict with what we've seen from monetary authorities, so the Fed, the Bank of England, the ECB, who had moved interest rates higher as they were moving through their tightening cycle. Through time, one would expect yield curves or that relationship to normalise, but it's just the environment we're operating in today.
Heading into the start of this year, many commentators expected a couple of interest rate cuts to play out. So we're now into 8 months into the year. There's still not been any interest rate cuts, but some commentators do think that we may see an interest rate cut as early as in August for the Bank of England. What's your view?
Yeah, look, August is very live as a meeting. So we still see room for rate cuts to materialise through 2024. The ECB has moved first. We see room for 2 more cuts, which would get to 3 in total for the ECB. In the US, we see room for at least 2 cuts by year end. Data remains solid. Growth has been slowing, and that combination of a weakening labour market and a string of weaker inflation print means the market is continuing to price 2 cuts there. And then, as I said, in the UK, August is a live meeting, and our base case is that the BOE will deliver on 2, maybe 3 cuts by year end. So we'll see what transpires in August, but we still very much see room for those rate cuts to materialise.
As you explained earlier, when interest rate cuts have been rising, we've seen bond yields increase, but bond prices decrease. So when interest rates are cut, how will the bond market be impacted? We're surely then going to see the reverse of that, aren't we? We're going to see some yields fall and some bond prices rise.
So I think you need to take a step back and look at where we are in the overall bond market. So unlike a few years ago, we're in a situation now where 80% of bonds are yielding over 4%. So you've got much higher yields or interest rates. We also anticipate that the rate cuts will be gradual, so we'll see this gradual descent. So you're in an environment now where actually fixed income is interesting again. The yields on offer are attractive, even if the marginal move in interest rates or in yields is lower. So what that means, I think, for investors is there is a really attractive opportunity in markets to lock in yields. You could do that through bonds directly. You could look at fixed maturity products, iBonds, a range of ETFs that we launched, which have that term maturity characteristic. So they essentially buy a basket of bonds that mature in the same year. It gives you a way to lock in yield or that income from a diversified set of fixed income securities ahead of any rate cuts or in anticipation of rate cuts. So I think there are a number of ways investors can look at playing in today's market, which, as I said, versus where we were a few years ago, in absolute yield terms, is materially more interesting than things were.
And that range you just mentioned, are they similar to money market funds or are they a bit different from them?
So iBonds, think about them as like any other fund, like any other ETF, they'll trade in the same way. You get the benefit of a diversified basket of securities. So across a given market segment, the way that we've structured them is that the bonds in each of those ETFs will mature in a given year. So say 2026 maturity, the bonds will all mature in that year, and then the principal is repaid at the end of that year. So you have a characteristic for the overall fund that feels much more like a fixed income security. You earn the income or the coupon payments through that period of time. Just picking up on the money market question that you asked specifically, though, they do carry credit risk. So depending on the market segment that you choose exposure to, you'll get more or less risk. So we have products that are, at the safer end of the spectrum, which will be US Treasury or government securities. We've got investment grade corporate bond versions of the product. Obviously, they carry a little bit more risk. They're still investment grade, so they're still pretty safe. That gives you a little bit of spread premium or credit risk premium over sovereign securities. So not exactly like money market funds, but what we are seeing investors do is use them to complement cash and money market holdings, as I said, where they are prepared to deploy their capital for a little bit longer from an investment horizon perspective for that pickup in yield.
And of course, exchange-traded funds, ETFs, provide exposure to different areas of the bond market. Are there any particular types of bond ETF that you think will fare better than others when interest rates are cut?
Yes, look, I think the amazing thing about ETFs and fixed income ETFs is that they offer a very granular exposure to almost any part of the fixed income market. So there are government bond ETFs, which work very well in elevated interest rate environments. They offer a very safe risk return sort of profile, if you like. Investment grade corporate bonds. Similarly, you can pick your exposure, whether you're looking to get exposure to the US dollar market or to the sterling market, down to riskier parts of the bond market in emerging markets or high yield, or even very precision exposures. So an example there is India is very much in focus at the moment. We've launched an India government bond ETF, which sort of ties to the inclusion of Indian government bonds in some of the emerging market indices. That started to be phased in this year and will follow in with other indices from next year. That inclusion means Indian bonds are getting a lot of interest. You're seeing a lot of investor appetite to access that market, which historically has been very underwritten. So we're seeing investors who typically would build portfolios professionally look at that as one segment. So that's a very precise exposure in terms of products that would fare well. The other dynamic that you can look at gaining exposure to in a portfolio is very specific maturity or duration cuts. So you could take exposure to the short-dated part of the bond market if you were particularly concerned about the movement of longer-term interest rates, for example.
So passively managed bond funds, which are structured as either index funds or ETFs, they have their biggest positions to companies or countries with the most debt. Whereas in contrast, an actively managed bond fund, the professional investor arguably has greater freedom as they can assess the financial strength of bond issuers and they can cherry pick the best bonds to fit into their strategy. So could you make the case for bond ETFs over actively managed bond funds? And do you mind addressing the potential issue that, the bond ETFs, their top exposures are to companies or countries that have more debt and therefore maybe less secure financially?
Sure. Look, ETFs offer diversification. Buying one ETF will get you exposure to a very wide universe of underlying securities that you couldn't necessarily buy individually. A good example of this is the Global Aggregate Benchmark. It's a cornerstone benchmark in fixed income markets, covers the vast majority of the market. That index alone has over 30,000 bonds. In the ETF that we manage, there are over 15,000 bonds, so accessible through one trade for a very low investment amount. As I said before, ETFs also offer a lot of granularity, so investors can select specific credit risk or specific parts of the market. So you can err on the side of caution with investment grade or government bond exposures, or take a little bit more risk in your portfolio with parts of the market like high yield or emerging markets. So just to address the question on the largest weights in fixed income indices being from the biggest issuers, what you tend to see is that the largest issuers in fixed income indices are the blue chip companies, so very similar to equity indices. In the corporate bond market in particular, larger companies, as I said, will tend to be the biggest issuers, but they also have the largest asset bases and revenue to service that debt. So being a bigger issuer doesn't necessarily equate to being a riskier company. Actually, if you take one of our ETFs, the European investment grade corporate bond ETF, we looked at the top 350 issuers in that benchmark and then the bottom 350 by amount of debt outstanding. And what you see is the larger issuers have a higher credit rating, so the quality or the strength of the balance sheet, etc., reflected through that credit rating than the bottom 350 issuers. So, as I said, many of those companies held or at the top of the fixed income indices by market capitalization will be very familiar names to equity investors. And so I don't think it holds that just because you are a bigger issuer, you are more risky. Another important nuance in fixed income indexing is there are some fairly simple rules that you can put in place with benchmarks to cap that issuer exposure. So, for example, you could put a 2 or 3% issuer cap, which would ensure that you retain that diversification so that you didn't end up with a benchmark that was entirely dominated by one issuer. You could also exclude higher risk countries or sectors, again, to help limit or mitigate that concentration risk.
And I also wanted to delve a bit deeper into how BlackRock's bond ETFs are structured. So my understanding is that due to the complexities of the bond market, that makes fixed income ETFs or bond ETFs very different from stock market ETFs. While stock market ETFs generally copy exactly the shares in their benchmark index, such as the FTSE All-Share, bond ETFs tend to sample the index in an attempt to replicate its performance without having to copy it exactly. And the reason why is because it's a more cost-efficient and practical way than owning thousands of bonds physically. Is this how BlackRock's fixed income ETFs are structured? Do your ETFs sample the index rather than owning it in its entirety?
Absolutely. So you'll often hear people say that index investing is anything but passive, sort of tongue-in-cheek comment. So particularly in fixed income indexing, rather than being very strictly bound by a monthly rebalance cycle or being forced to hold every constituent name or even every constituent issue rather than issuer within a given benchmark makes sense, exactly as you said, from a liquidity, transaction cost, and ultimately a performance perspective. So at BlackRock, we run our fixed income ETFs in a very pragmatic way. They're all physically replicated, meaning we buy the underlying security, so we buy bonds rather than using derivatives. We follow, as you pointed out, what's called a stratified sampling approach. So what we'll seek to do there is to match the risk profile of a given benchmark, and we'll give our portfolio managers latitude to manage the nuances of the bond market, whether that's new issues or index rebalances. As I said before, what we're trying to do there is balance risk return and transaction costs so that we can deliver the best possible performance experience, ultimately a performance experience that's as close as possible to the benchmark. So one of the ways that we'll do that is we'll divide the risk of the benchmark down into different subcategories, if you like. So we'll look at things like sector, maturity, credit rating, seniority, country, etc. And then we'll pick bonds from each of those sub-segments to build a portfolio that represents the overall characteristics, rather than trying to go out and buy every single line item and in doing so incurring undue transaction costs. So we feel this is the appropriate way to manage index fixed income. As I said, it balances tracking error or the deviation that you might see around a benchmark from a return perspective with liquidity and transaction costs, and ultimately delivers performance which is very much in line with the given benchmark. So to give a sense, something like the global aggregate ETF that I mentioned, benchmark has 30,000 bonds, over 30,000 bonds. Our portfolio holds some 15,000. So over time, we've obviously been able to buy a lot of bonds as the portfolio has seasoned, as we've had time there. The tracking error for that product, or the tracking difference, so the return that the product's been able to deliver net of fees, is 10 basis points versus its benchmark over a long period of time. So it delivers very, very close tracking. And similarly, if you look at another example in the maybe a more difficult to trade space like the European high yield market, the ETF in that instance actually holds more bonds than the underlying benchmark. That's because we've been proactive in buying new issues before they come into the benchmark. They're typically cheaper to access at the point of issue rather than waiting for them to come into the benchmark. So we have that pragmatism around the index itself, and we've held bonds to maturity rather than selling them at the 12-month point when they typically fall out of indices. So some practical things that you can do when you're managing these products to protect returns for the investor. It's all prudent, efficient portfolio management.
My thanks to Brett, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. If you get a chance, it'd be great if you could leave us a review or give us a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like us to talk about via email on otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.